Hi, this is David. Let's take a look at John Hull's chapter on the determination of forward and futures prices. And we have several learning objectives associated with this chapter, although we'll tell you that there's some redundancy and overlap, especially of these final third to the first two-thirds. So there's fewer specific separate concepts than meets the eye at first glance. And also I'll tell you that this chapter is really all about the cost of carry model. You can see that phrase is buried right here in the middle somewhere. And this is a single model that we can use to apply to the theoretical pricing of a futures contract. And it's going to be applicable across the commodity asset classes. And so there's really just a single model here. So overall, this chapter is not as difficult as it looks like at first glance from those learning objectives. Although we start with an important conceptual difference here between an investment and a consumption commodity or asset. Why are we making this semantic distinction? After all, the commodities exchange isn't necessarily classifying them this way. It's classifying them by the different commodity asset classes. Well, John Hull has a specific purpose here, and that is that an investment asset must have a convenience yield of 0. What's a convenience yield? A convenience yield is a factor in the model, and that's any benefit of owning the commodity as opposed to, for example, just having a long position on the futures contract. If you enter a long positions on the futures contract, you're expressing a view, you're long the commodity, but you don't own the commodity. And owning a consumption commodity in general confers the convenience of ownership, which includes the optionality. You can do something with it. And so that's in the factor, in the model, that factor is the convenience yield. So that, for example, in the case of crude oil, the ownership of stored crude oil confers some convenience, including optionality to the owner. And that's the key distinction. Consumption commodities confer a convenience yield. Investment assets do not. And then Hull actually finishes the chapter showing why that fact allows us to exactly price an investment asset, because the no arbitrage argument forces a truth about the futures price. But the convenience yield actually interferes with our ability to exactly price the futures contract on a consumption commodity. Okay, next we're asked to define short selling and calculate the net profit. So a short sale, as you probably know, expresses a view that the price is overvalued and actually wants to profit if the price of the stock or asset goes down or drops. And a key feature here of the short sale that can be easy to forget is that the investor with a short position must pay to the broker any income. So in the case of a stock, that's going to be dividend that would normally be received. So if you're the short seller, the dividend gets paid. The dividend that gets paid by the company, the short seller does not collect that. That gets passed along to the owner of the share by way of the broker. And that's because the short seller really borrows the shares in order to start by selling them and then buying them back later. Now, here's a key risk to the short seller. And I'll admit, while I've purchased stocks, I do have a stock portfolio, for example, I've never actually sold a stock short. There's just several risks associated with that. And one of them is the short squeeze. If the price goes up, the short seller is going to get a margin call, and all of the shorts to cover their position will need to will need to purchase shares to replace borrowed shares. So the short squeeze can actually be quite a bit of risk. Just today in the financial press, another story, almost daily, there are stories about short squeezes happening on several of these stocks where short sellers thought they were overvalued, but the prices are ticking up and they're covering the position, and it's painful to the short sellers. So in terms of the calculating the net profit, so here's a very simple example. I think this is directly from Hull, and here at time zero, the short seller is borrowing 500 shares when the price is $120 in order to sell them. So that's the initial step, borrowing the shares to start by selling them. And in this case, that's a cash inflow of 500 shares times $120 per share of 60,000. And then a month later in this scenario, the stock actually pays a dividend of $1. And so this, I think, can be the counterintuitive part. That's $500 in dividend. The short seller, who after all has borrowed to sell the shares, is not going to collect that dividend. The short seller is going to pay that dividend, pass that dividend along. So in terms of cash flow of the short seller, that's a minus 500. And then in this scenario, it works out for the short seller because the price did drop from 120 to 100. And now the short seller closes the position by buying those shares back. So that's a cash flow of negative 50,000. And we can see here that the net profit is 9,500. So there's 10,000 on the price drop, but that net profit has been reduced by that dividend. We're asked about the difference between forward and futures contract, somewhat thematic. It came up in a couple of chapters previous, so we've seen this before. I hope it's somewhat familiar. It's important to us. The futures contract trades on an exchange, and if it trades at an exchange, it offers liquidity to the different buyers and sellers. It does that by standardizing the contracts, defining the specification, the quality and grade of that commodity, the delivery months, rules about the price limit. And so all of this standardization makes possible the liquidity on the futures exchange. Whereas forwards trade over the counter, as we say, OTC, and they are not standardized. Also, I note here on the schedule, recall that futures contracts, the majority of them, maybe over 90%, I believe, are closed out prior to delivery. So the short is actually not, in the vast majority of cases, the short futures contract position is not actually delivering the commodity. They close out that position.